Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna, CIO of Old Farm Partners. Our goal is to bring you great investors and the themes they're working on. Some are under the radar, and we think they're all experts in their fields. Today, I'm excited to have a discussion with Val Zlatev of Analog Century, a hedge fund in New York City. They have emerged as one of the leading technology investing hedge funds in the world, running $2 billion. Analog differs from a lot of other tech funds and tech investors in that they have a much stronger historical focus on hard technology like semiconductors. As an allocator, I have not encountered a group that is as knowledgeable in the hard tech and semi space. And with this incredible focus today on semis and all things artificial intelligence, I thought it'd be a great discussion. So welcome, Val.
Hey, thanks, Kieran. That's such a great introduction. And thanks again for the opportunity of having a discussion with you. I actually listened to your podcast, Scott Besant, and I was like, oh my God, what did I do to actually deserve to be on the same podcast as Scott Besant? So I hope I can meet the high bar you just set for me.
That's great. Well, maybe you're the future Treasury Secretary, so who knows?
Goes for a bit.
I'd love to kick off some info about you. If you don't, you have an incredibly interesting background. So could you just give us a brief history of you and how you're sitting in the seat running this large hedge fund?
Sounds good. Yeah. So from my accent, I'm sure you can figure out I wasn't born in the United States. I was actually born in Bulgaria, in Eastern Europe. And I was born when Bulgaria was still a communist country. It was behind the Iron Curtain. There was no markets there. So there's no way I can tell you that I was a young kid looking at the Wall Street Journal, investing into stocks. That didn't exist. No, there was not a concept of markets over there. The way I grew up, it was dreaming of escaping to the United States. That was my dream and goal. So I wanted to be in the United States. I wanted to be a top-notch physicist. And I just wanted to get a Nobel Prize. That was it. So having said that, I clearly didn't get a Nobel Prize. I did become a physicist in the United States, but there were three experiences that kind of led me to that point of my career. It's kind of funny how little things shape your life, at least my life. So the first experience, it was really about a life-changing opportunity and just catching it. And that life-changing opportunity was when I was 20 years old. I had just finished my military service, and the Berlin Wall fell apart. And the Bulgarian communist dictator was taken off the curtain. And the next morning, literally the next morning, I was like, I'm going to the American embassy. And there was a KGB line sitting in front of the embassy. And they look at me like, what are you doing here? I'm like, what are you doing here? You're done. I'm leaving. So I literally went to the embassy. I sat there for like many days, probably for over a couple of months. I went through all kinds of catalogs about American colleges. I applied to about 60 different places. And that was my hope, right? My hope was to get accepted somewhere. And I was lucky that one college actually gave me a full scholarship, full ride, which since I didn't have any money. And that was a transformative situation for me. For me to be able, at the age of 20 or so, to be able to leave, that was fantastic. And then I studied physics. I got a PhD in physics. I ended up going to Penn, finished up at Princeton. My advisor is actually the Einstein professor of physics still at Princeton. So he sits in the Einstein chair. So I did get to the very, very, very high ranks of physics. I think, by the way, he should have a Nobel Prize. I don't know why he doesn't, but I didn't. The second experience was, it was sort of like I was into this whole very high big picture when I was in when I was in academia in Princeton, because I was doing cosmology. It was like early stage universe, very, very high level stuff. It's like the biggest picture in the universe you can imagine. Really, what happened in the first microseconds of the universe, and then it's all details after that. I wanted to actually move away to something much more practical. And then when I finished my PhD, I went to McKinsey, which was a consulting company. And that's where I actually moved from super high picture to something a little bit too nitty gritty and too much in the detail of corporate America, really down in the corridors with all the CEOs of tech companies. So I spent my 7 years there working with the CEOs of a bunch of tech companies, including semiconductor companies. That's where I formed my opinions about supply chains, how they work, all the linkages, all the different strategies that they deploy. But then there was a pivotal moment that actually even got me to leave academia to go to McKinsey, and got me to leave also McKinsey then to move to the hedge fund world. And the pivotal moment, second pivotal moment in my life was I was in my last year of my PhD thesis. I was in Chicago for a academic conference, and I went to the stock exchange, not stock exchange, the commodity exchange in Chicago. And the commodities exchange in Chicago then was actually had traders on the floor, and you can go to the second floor, look down, and you can see what's happening with these traders. And the amount of energy on that trading floor was insane. I mean, this is the guys who were like, cutting up papers. They were doing all the little signs with their fingers, throwing stuff around. And I was sitting there like, oh my God, the amount of energy I'm seeing here over the last 1 minute is bigger than the amount of energy in physics for the last 500 years combined. So I was done. So this moment was like, I need to be somehow in the trading world because that energy is just intoxicating to me. Didn't quite happen there. There was a whole other story. I ended up in McKinsey, learn all the nitty-gritty stuff. And then eventually, 7 years later, this experience of the stock exchange actually led for me to go into the buy side. And that was the perfect marriage, as far as I'm concerned, between the very, very large picture of the cosmos and the universe at the very beginning, marrying with the nitty-gritty stuff of the corporate life, day-to-day life in a corporation. Hence my long-short equity in the tech world exposure. So that's sort of these little experiences that formed what I am.
I mean, I love it. I mean, you hear about guys going different routes, whether it's commodities, whether it's, I remember Bruce Kovner from Caxton was a musician, George Soros, who I work for, a philosopher. And so glad to hear you. Too bad you're not solving some of the universal riddles, though, in physics, but I'm glad you're here. So
I think they have great people solving them still, whatever is left, whatever little is left there.
I would love to hear just a bit of how you define hard tech. And we'll get into the strategy and what you're seeing today, I think, because it is the focus for the entire market at the moment. But how do you define hard tech, and tell us a bit about your strategy?
Okay, sure. So the way I define hard tech is semiconductors, systems. Think of PCs like smartphones like Apple, Dell, HPQ, that kind of stuff, in communication equipment. Think of Cisco, Juniper, these kinds of companies. So it's basically TMT without internet and software. This, by the way, happens to be about half of the universe of TMT. About half of this universe in terms of market caps, not even including the $3 trillion market cap of NVIDIA, even if you take that stuff out, it's still about half of the market cap of the universe is in our universe. Funnily enough, there's not that many people who really focused on it. The other 99 TMT hedge funds are really all in internet and software. But that's the definition of it. You mentioned the strategy that we deploy in that space. So we have to actually have a different strategy for the long side of the book versus the short side of the book. And on the long side of the book, we basically want to be owners, like buy and hold for an extended period of time, of companies which are transformational in a number of ways. Transformational for our lives, transformational in terms of the EPS growth, basically companies that drive and benefit from big inflection points that are happening in the space. So we buy and hold, and we compound alpha on our longs, which, by the way, is very, very different from the strategy of most pots out there, where it's a lot of trading on and off all the time. On the short side of the book, it's more like the traditional hedge fund strategy, which is Yeah, find stocks which are not growing that much. There's some contraction in EPS because margins are threatened or whatever it is. And the holding period is not that long. There's not that many melting ice cubes at the end of the day. They don't necessarily go to zero. So if they go down 20, 30%, fantastic, cover, move on. So it's very different strategy from that perspective. And we deploy to actually segregate what goes into longs versus shorts. We deploy a 4-point framework to decide what really we think deserves to be a long. Number one is exposure to big inflecting themes. I mean, think of AI. I'm sure we're going to spend some time on AI, but there's other things also. Something that really drives revenue growth. Number two is companies with high market share and high staying power, which basically ensures high margin profile, actually increasing margin profile, because many of these companies have increased their margins over time. Number three would be healthy balance sheets and cash flows. And by the way, many companies in our space have dividends, buybacks, huge cash flows. And finally, number four, not last but not least, is multiples. We're not slaves to cheap companies or garbage, none of this stuff, but it's we look at the multiples to be justified on what we believe are the earnings potential over the next 2 or 3 years. So if something like over the next 2 or 3 years can earn X and the multiple is say 15, 20 on that X, we're fine with that.
Yeah, I get it. And it's been interesting to watch you because you consistently for a long time said we're hard tech. And I'm sure you got pressure to do more internet and when people are doing pets.com, right? And you just didn't want to do it. Why did you resist?
I'm a believer that people should do what they know and what they understand. So there are two reasons for that. Number one, people should stick to their knitings. And I have seen it firsthand when people deviate and linger into areas they're not experts of or experts in. Nothing good comes out of that at the end of the day. If you don't know who the Pats is, you're the Pats at the end of the day. So I'm sticking to my knitings and be very consistent with that, number one. Number two, because that's my expertise, that's expertise of the whole team here. My head of research, Peter Locke, has been together with me for like 12 years. So that's a long-term partnership. So sticking to that. So that's one reason. The second reason is there were meaningful changes, positive changes happening in that space even before we launched the fund. So we launched the fund in 2018. And even before that, like a year or two before that, I could see that there's a dramatic change happening in the space. So the space, by the way, just as a set of background, hard tech as a whole used to be a fantastic growth space in the 90s. Most of the big hedge fund managers made their wealth into the space into the 90s. And then it became cyclical, and there was not much growth, cross cycle, became a trading vehicle. So you can't really make a ton of money in a trading vehicle. So it was very normal for people to move away from it and focus on the secular growth like internet and software. So that became kind of a don't touch it kind of space. And most people, and the expertise didn't exist in the space because of that reality of life, right? The trading don't touch it vehicle. Now, around 2016, 17, I started seeing that, yeah, a chunk of the space is still that kind of unpleasant reality. But there is a piece there that is really separating in a very meaningful way because there were new trends that are starting to happen. Like everybody talks about AI over the last 2 years because of ChatGPT, right? But AI was actually becoming pretty real to some extent even before that. I mean, like the companies like Facebook and Google, all the social platforms and the search engines, they were using deep learning, which is the prior version of AI, for their recommender engines. And that was very exciting for us. We were seeing like electric vehicles were just starting to grow. Like Elon Musk with Tesla was very early, but there was a ton of growth at that point of time, and that was consuming a ton of content. There was an IoT growth happening. So there was a piece of the space that was very, very interesting and starting to grow meaningfully and separating from the old stodgy stuff, which was the perception of the space.
Well, that's great. Well, it's a great description. I learn something every time I read your letter. So I want to read something from your letter, if you don't mind, just to set the stage on the main event of the day, which is AI. So you wrote, this is from your letter. Despite share price outperformance of both 2023 and 24, we enter 25 even more bullish on the AI opportunity. We're entering the third year since OpenAI's GPT-3 model revolutionized what computing can accomplish. We see parallels between the adoption curve of AI and the internet. If 2023 was the beginning of the wide adoption of generative AI and mirrors the internet, in 1994, then 2025 is equivalent to the internet in the mid 90s. So let's just start with that. So that's I don't want to steal too much of your thunder, but where are we right now with AI?
So I'm standing to this statement, which is, I think we're still in a very early stage of AI. We are in year 2.5 of a multi-year development. We're just scratching the surface. We're yet to figure out the potential, the true potential that is going to come over time. And the reason I was saying that in our last letter is that the two main reasons why I'm even more bullish now than before. Reason one is the scale of investment into even training of these models is stepping up in a very meaningful way compared to over the last 2 or 3 years. So ChatGPT that everybody has been using, or Claude, or all these other AI models, all these models were really trained on clusters of 10,000 to 30,000 GPUs. That's it. That's all it was for like 2 or 3 years. This year is the very first time, actually last week, was the very first time we saw the output from a cluster with over 100,000 GPUs. This was the Elon Musk XAI cluster down in Tennessee, which was supposed to be 100,000. And then he showed up last week and said, well, it's actually really more like 200,000, even though I thought it's 100,000. Oh, by the way, that's nothing. I'm building over 1 million GPU cluster as we speak. So to me, it's very exciting when you're moving from 20, 30,000 GPU cluster to 200,000 to 1 million plus GPU cluster. It's exciting because we are the ones who invest in the picks and the shovels, right? All these processors and servers and storage boxes, networking. So that's good, awesome for us. And number two is the reasoning models. Let me just step back for a second. What most people have been using for a couple of years, like ChatGPT 3.5, 4.0, whatever it is, it's the traditional chatbots, like chatbot large language models. You ask it a question, it spits out an answer. There's that whole new set of models called reasoning models or chain of thought models. And these models are actually, they don't spit an answer right away. They actually start thinking like a human being. They go in a certain direction, they create a hypothesis, they test the hypothesis, they go back and forth. And the reality is that the output, the outcome is actually much better. The quality is much better. So it's a whole new step up in performance. Now, the performance comes at a cost. And the reason that's exciting from my perspective is because every single time these reasoning models move from one thought to another before they even give you the final answer, the compute intensity is just as much, or at least as much, as the compute intensity of just the simple answer from a chatbot. And if these models go from 50 to 100 steps, sometimes they go for many more than 100 steps, the compute needs are 50 to 100 times more than the compute needs for just a chatbot. So if you want much higher quality, and I think by now it's pretty clear to most people that the reasoning models is the way to go because the quality output is so much better, the compute needs are 50 to 100 times more. We want that. Yeah. If you're investing in the picks and the shovels, bring it on ultimately, right?
And Val, how do you, just to make it clear, what reasoning models out there, and maybe relate that to DeepSeek and why that was so disruptive because what I read now is so many people are now like, wow, we're not going to need as much compute for training. Just can you frame that for us? Because I want to make sure I'm not missing the nomenclature.
Yeah, totally. So DeepSeek, the nomenclature is the reasoning models are from OpenAI. You have O1 and O3, and they have O1 mini and O3 mini, which is sort of smaller distilled versions of these models. DeepSeek has both a chatbot as well as a reasoning model also. And DeepSeek has had a chatbot. They have had DeepSeek V1, V2, V3 for all of last year. So everybody sort of who is down into the weeds knew that DeepSeek exists in 2024. But it was just a chatbot. It's no big deal, right? Then they disclosed a reasoning model just before Christmas. It was called R1, DeepSeek R1. And subsequently, Claude, I think, just released the reasoning model. Google released the reasoning model also, Flash 2.0. So everybody now has a reasoning model at this point of time. So OpenAI was first. and then DeepSeek, and then Google and everybody else.
And this is not quite AGI, correct? We're not there.
Well, I don't think we're there. The definitions of AGI are very vague. I don't even know how you define AGI, to be honest, but I wouldn't call it AGI. It's not there yet. It's definitely not there. Now, the DeepSeek Monday, which was sort of like a crash, in that space, was when a couple of days before that, DeepSeek released pricing, which felt very disruptive. So they released pricing for the reasoning model, which was like, I don't know, 20 times lower or something like that than the pricing of the O1 model from ChatGPT. So they were comparing something that was developed 9 months before that by OpenAI to something that was developed right now in January. So there was this time span delta of 9 months of development between these two. So it felt very disruptive, this pricing. And on top of that, they published these white papers where there was a number thrown. It took them $6 million to develop it. And then the social media know-it-alls on Twitter and whatnot decided that, oh my God, look at that, $6 million achieved what $10 billion that OpenAI took away from Microsoft couldn't achieve. So on and so on, right? This was all very misleading stuff, right? Because at the end of the day, DeepSeek actually, maybe the very, very final round was $6 million, but by all accounts, they have like 50,000 GPUs. They have spent well over $1.5 billion on infrastructure. Well, probably $2 billion plus on infrastructure. So the $6 million I will say ridiculous number. It didn't make any sense whatsoever. And on top of that, the reason actually a number of things kind of stabilized post the DeepSeek moment is because O1 actually released O3 Mini a week later, really at the same price as DeepSeek. And Google, with I think it's Flash 2.0, it's at the same price also. So the pricing of DeepSeek is not disruptive in any way. It just
right. So maybe related back to what you said about now these reasoning models are, they could have substantially more compute. I mean, so this is not a derailed, thesis in any way, correct?
No.
I mean, maybe you could walk us through, how you think this is going to play out.
So the thesis is absolutely not derailed one bit. And the very fact that actually Elon Musk showed up 2-3 weeks after the DeepSeek moment, right, and disclosed Grok 3.0, and he said 200,000 cluster is much, much better than a 20,000 cluster. And he showed the performance, right? Grok 3 has better performance than all the chatbots before that. And by the way, last night, as we speak, there was an article that Facebook, Meta, Mark Zuckerberg is dedicating $200 billion now, which is like 4x his current year capex. So all of these guys are clearly seeing actually meaningful benefit to pushing the scaling laws on just the pre-training even. So let me step back and explain basically what scaling laws mean. So there is the scaling laws in artificial intelligence are kind of empirical laws, kind of like the Moore's law in semiconductors, that through observation, what you see is that the more data you throw into a model, or the more parameters you give to a model, or the more time you train it, or the more compute capacity you have for the model, the better the output. That's the model. It's like bigger is better. It's simple as that. Bigger is better. And there was this whole concern over the last 6 months that was saying, oh, the scale laws may be broken. Maybe you don't need these big clusters anymore. And there was a lot of nervousness in the industry. And there were like luminaries coming out and saying, yeah, it's kind of broken. And I was sitting there, I'm like, why are people saying that? You have never seen an output of anything over like 30,000 GPUs. You have to wait for XAI to come out. Well, XAI came out last week, and it was definitely, they proved that bigger is better again. They actually proved it empirically, through reality, that the bigger the cluster, the better the output. And he's going to bigger ones, and Meta is going also to bigger ones. So that was on the pre-training side. So this whole narrative it was a pure narrative in the market for a while. The scaling laws are broken. You don't need these big clusters. You can do it with much less than that. This was nonsensical because there was no empirical proof to disprove it. And now we have the empirical proof to disprove it. So it's wrong. Now, on the reasoning side, the reason is actually scaling at what's called inference. So inference is you've already trained the model, and now you start asking it questions, and it gives you answers. So you have a whole new scaling laws now at the inference stage. And they're alive and well. Everybody's going to these reasoning models. The outcome is much better. The usage is much higher of these reasoning models. And even Satya Nadella from Microsoft, who is actually not making a bet anymore on any training models. He's not making a bet on, he doesn't have his own models anyways. He just have an investment in OpenAI, and he's actually stepping away from that investment in OpenAI. He's leaving that to Oracle exactly, and SoftBank. They actually investing a ton now into inference. So they're building a ton of centers for inference because they realize that inference is huge. It will be probably dwarf training, and you need to be able to support all kinds of reasoning inference models. And this reasoning inference sucks a ton of compute capacity. That's what they know. That's what they're doing.
Very, very interesting. I know. And so that tells me a lot about the direction. But, I remember in the depths of COVID, you wrote about that we were on an epic, massive CapEx cycle. And I thought, let's see if he's right. Right. And obviously, the trade of a lifetime has been NVIDIA. And I know you've been involved in it the whole time. So maybe take us to then how you think about where we are right now on that cycle and for 25 and 26 and how you're investing yourself.
So from a AI perspective, I think basically what we just discussed, my point is that the AI cycle, the CapEx cycle for AI is accelerating, is getting bigger as we speak, because the clusters are getting much bigger, like tripling, quadrupling, pentupling in size, and the reasoning model needs a lot more compute. So actually the CapEx is accelerating. It's not decelerating, it's accelerating. That's what I'm saying here. That's the bottom line. And a lot of that will be happening towards the back end of 25 and into 2026. So 26 is likely to be a fantastic year also for CapEx investments. I hesitate to be going all the way far out there, like 10 years out. Who knows? But I will compare, in terms of longevity of these investment cycles like AI, I would compare, or I have compared many times, the AI investment cycle to the investment in the cloud. So if you think about the cloud, right, it started in 2012, and now we're 13, 14 years later in that investment cycle. And that cycle has been strong and alive and well for well over 12 years. And the CapEx has never been down for these 12 years from these companies that invest in the cloud. 2022, which was horrifying year, it was kind of flattish, slightly up, flattish. If it's not, that was the worst year. Every other year was like up 20%, up 50%, up 20, up 50, whatever it is, right? It's growing. So from my perspective, there's a lot of similarities between AI and the cloud in terms of being a new compute paradigm, new accelerated compute paradigm. It's driven by the same companies, if you think about it, right? It's the Amazons and the Microsofts of the world. They had the same pipeline of customers of their own, the Fortune 500s and 1000s. This is all built from their free cash flows. It's not borrowed money. It's not venture capital money. It's very similar to the cloud. So I can see a lot of longevity to that going forward. Now, that's on that. In terms of overall CapEx investments, there's other CapEx investments also, right? This is not just AI. We can chat about that if you want, but you can take it in any direction you want, Kieran.
Yeah, sure. When you look at the stock market, I'm getting questions from buy investors where are we? And, what's interesting about what you're saying is we're early
I think we're early. Yeah.
Right, yeah.
Oh, trust me. I've been getting the same question, God knows how many times over the last year and a half. It's not just the last 3 months or 2 months, or of course I'm getting them right now. But it's been a while here where I constantly have to answer the question, is that the peak? Even in the end of 2023, many people thought that was the peak and 24 should be down. And then in 24, the question was, is that the peak? No. Now the question is 25 the peak? And now it's moving to 2026 the peak, right? It's always that intrinsic need to somehow call a peak. I don't know. It's sort of cute. to be calling peaks. It's constantly like that. And then the question on NVIDIA, you mentioned NVIDIA, right? Always like, oh, I mean, shouldn't that be game over for NVIDIA, right? I mean, look at all this competition out there. I mean, doesn't AMD have, look at all the, AMD has chips, all the hyperscalers like Google and Amazon and soon to be Microsoft, they have their own chips. Wouldn't that take away their margins, right? Either way, them. And then, of course, the venture capital guys have invested in like a plethora of little startups. It wouldn't that take away from NVIDIA, right? So that's kind of, I face that question all the time. So do you want to go in that direction or?
No, I'm just, it's interesting. I mean, and I guess what is interesting about this cycle is that the innovation, it's a great point you made about the cloud. That's coming out of Microsoft and Google, right? Another tech investor I know, he's super skeptical of almost all the venture investments going to AI because they don't have the resources that these big guys have.
I'm also very skeptical. Do you want to go there? I mean, let's chat a little bit about that. I still remember, actually, in 2018, we were launching the fund. Goldman Sachs has usually that conference for brand new startups, hedge funds, down in Florida in January, right? I'm sitting there in January and in a group meeting, and at least half the groups, and I think I was talking about NVIDIA, Marvell, whatever it was. And there were a number of investors that invested in both hedge funds on the public side as well as venture capital investments, right, into startups. And at least 3 of them told me, you know what? You keep talking about NVIDIA. I just invested into that startup, which is the next cure of NVIDIA. They're the cure of NVIDIA. I have heard that cure of NVIDIA many, many times. And to be honest, nobody has killed it. And here's why. Number one, NVIDIA is spending, I think it spends like 15 or $20 billion a year on R&D. It is very hard to compete from a venture capital perspective with $20 billion a year in one specific little sector, which is accelerators. That's all they do, right? Networking accelerators. So that makes it very hard to compete. Number 2, they have developed this ecosystem, software ecosystem called CUDA. So it's sort of like a language of, it's basically, it's kind of like the C++ of AI. So they have like millions and millions of AI developers trained on CUDA. All these AI codes until now, they're written on CUDA. Go ask any kind of software developer to rewrite his code away from CUDA to something that works on some startup's chip. It's very hard for them to do that. I mean, the risk is very high. And the benefit is not that high at the end of the day. Because like a startup, for example, like Grok, which people talk about out there, I mean, Grok is accelerated for specific workloads, but it's very poor at batch workloads. You cannot put Grok in a big data center when you have to batch, basically put together the workloads of many different enterprise customers and run them in parallel. You can do one at a time, but you cannot parallelize a ton of these workloads. So it's very hard from that perspective to break the software mode, the developer ecosystem mode, the huge investments that they make in that space is very hard from that. Basically the barrier to entry is very high. Yeah. That's the bottom line.
At risk of being too focused on NVIDIA, I mean, what other things are you thinking about in hard tech that are very interesting to you, maybe less well-known?
Yes, so there's a number of other interesting things. And for example, I'm currently thinking very heavily about what I call the broad cyclical names. These are like analog companies which make semiconductor chips, which are like power management chips, analog chips, whatever it is, which are used in everything in the world, automotive, industrial, all kinds of stuff like that. So these companies, they're cyclical because if you're exposed to industrial, it goes through industrial cycles and so on. They went through first of all, during COVID, there were heavy shortages because the supply chains were broken during COVID. And I don't know if you remember, Kieran, but you couldn't buy cars. You couldn't buy a car during COVID because there were not enough chips for these cars, right? So the newspapers were writing about this stuff for like a year and a half. Of course, human psychology never changes. And the purchasing managers, the car companies, as well as the industrial companies, of course, overbought, right? Because the lead times were stretched. You couldn't buy it. So if you don't buy, you can't buy your quadruple order stuff. And then they went through a horrifying down cycle. Like for the last 2 years, the revenues of companies like Microchip, ST Micro, Texas Instruments, ADI, you name it, the whole slot of these companies, right? The revenues has been down anywhere between like 35 and 60% from peak to trough. 40 to 60%. I mean, that's a wild number, right? I mean, can you imagine how it feels to be there? I haven't seen that. So I've been doing that for a while, right? I did not see that in 2008. I did not see that in 2000 either. That's a much bigger downturn. Now, these downturns don't continue forever. That's kind of done. I think we have stabilized it, and it's sort of primed for a new upturn to begin. And when a new upturn begins, which may be happening in the second half, we'll see, of the year, the earnings growth of these companies can be actually much faster than the revenue growth, because now the revenues are cut in half, which means the manufacturing facilities are heavily underutilized. They're sucking underutilization charges and high fixed costs. And the minute they start filling the facilities, all of this stuff goes away and the gross margins expand. So you have gross margin expansion in addition to revenue growth, which propels EPS.
Right.
So that makes it exciting for me.
But it's funny. Like I in a discussion with another fund, they told me that Texas Instruments makes 100 million chips a day, and I thought, oh my God, that's obviously a typo. And I went there, and it was true, right?
It's true. They make billions a year. It's extraordinary.
Right.
Many of these are little things, right? I mean, you have a wafer. There's like thousands and thousands of these very, very little chips that they make, right? They're small chips. The average price is like probably 50 cents to $1, and the size is tiny. Very different ball game from NVIDIA, where you get like 25 chips per wafer because they're large, and each of them they sell for like $40,000. Kind of thing, right?
It's incredible. Maybe a quick aside, since we talked about your physics background, and you're probably equipped to. I understand you were doing cosmology, so it's a little different. But is it amazing to you how far we've come? The last 2 decades that you've been looking at technology and sort of how we've gotten to the Moore's law was the big thing we were talking about 10 years ago, and we're basically stopped there, but we've changed how we're doing things in such a way. I mean, has it been amazing to see sort of the human ingenuity coming out of Silicon Valley?
Yeah, I mean, let me think about this a little bit. There is a lot of, I'm not sure the ingenuity is coming from the Silicon Valley, to be honest. I'm not saying there's nothing coming from there. For sure, there's plenty, but it's a lot of the ingenuity around dealing with the slowdown of the death of Moore's law is really coming from very large companies, like the likes of ASML, for example, right, in the Netherlands, or Applied Materials in the West Coast, whatever it is. So let me just step back for a second as a setup. For many, many years, for decades and decades, there was this thing called Moore's law that every 2 years you shrink more transistors into a semiconductor and the power drops by half and the power consumption decreases and the price drops a lot. Fantastic thing, right? I mean, it's like the best thing in the world. But then the whole thing slowed down. The reason it's right now it's not even working that much anymore is mostly because of quantum mechanics. At this point of time, you're packing 150 billion transistors into a chip, which is kind of the size of a fingernail. 150 billion, right? These things, these structures on my fingernail are spaced by about 5 atoms at this point of time. So you have to do atomic scale manufacturing. Really, you're pushing atoms around. That's what you're doing there. You're messing around with spaces 5 atoms apart. And when you have these tiny spaces, you have quantum mechanical effects like electrons, quantum tunnel between the walls of these semiconductors. So I was doing physics, and I thought I would never say quantum mechanics in my life the minute I left Princeton. But I've been talking about quantum mechanics for the last 5 years, at least. So you're right. It takes a ton of ingenuity to actually deal with that. It takes a ton of ingenuity to stop really these quantum tunnelings. So you have to raise the walls. Now they're moving to nanosheets. It's very complicated stuff, which comes with the cost, by the way, again. Like, speaking of the cost, the facilities to build semiconductors, back in 2000, when sort of my early stage life in McKinsey, I was actually working in the fabs of some facilities. I was up in Fishkill in fabs. And a big facility, state of the art back then, was $1 billion. That's it, $1 billion. It was a lot of money. Now, state of the art for the same size is $50 billion. 50. I mean, And the reason for that is because it's really all the equipment that goes inside. And the equipment like ASML, for example, back then, the most expensive equipment was $10 million per, or five to $10 million per machine. Now, the ones that they've been shipping for a while are $200 million. The ones they're booking now and they will be shipping over the next 9 months are $400 million each. And you need several of these per facility, not one. You need several of these things. So this increment from 5 to 400, this is because of quantum mechanics. And that's the ingenuity. That's where you do crazy stuff to be able to do atomic level manufacturing.
I've looked into ASML myself, and it's just, it is the bleeding edge of human brains. It's an amazing thing.
It is the extreme bleeding edge. If you think that writing AI codes is complicated, no. It's like child's game compared to what these guys at ASML have to do.
That's incredible.
It's really child's game.
I would love to switch back to the markets. I mean, obviously you're very smart and you have some great backgrounds, but how is it investing in these things? I remember when you were talking about this huge CapEx cycle in 2021, I kind of moved on to the next thought that was something in energy, but where you have a big thought, you're seeing something, and then how does it translate into actually making profits?
So the way we're thematic investors, and once we identify a theme, which we do a ton of work on to get conviction to that theme, then the question is, how do you make money in that, right? That's ultimately the question. And it's coming back to identifying the right companies that really will benefit from that. And it's a ton of bottoms-up work. It's, as usual, it's meeting all these companies. You talk to them, you talk to their competitors, you talk to the full supply chain, and so on and so on. But it's really getting the conviction of who is going to be winning. And that's coming back to the 4-point framework I was talking at the very beginning, right? Which is identifying the theme, right? Check mark on that. But then, who has the high market share? Are they going to be able to keep it? Are they going to be able to keep these gross margins? What are the modes, right? It's sort of like a little bit of what we discussed on NVIDIA, right? CUDA is a big mode. The $12 billion investments per year in R&D, that's a big mode. By the way, I didn't even mention the other mode that NVIDIA has is, because Moore's law is that now you're doing Moore's law at system level, where you actually, to get the increment in performance, you're connecting now 72 graphics processors through a system to work like one. And then you actually link these 72 through very fancy networking to make a system of like 570 of these work as one. That's the only way actually is through system level that you're pushing the Moore's law at this point of time. That's another mode, right? So identifying these modes, which actually gives you confidence that you can keep the gross margins, that's actually another thing which is very important for us. But then even then you can say, okay, fine. So you do all this work and you identify the winners. And then it comes down to holding power. It's really easy, by the way, to get scared. I mean, it's scary, by the way. Markets are scary. Markets are hard. I will tell you right now, it's very hard at the end of the day. We can talk all day long about NVIDIA, right? And you've seen now 13 Fs over time. I cannot say anything about right now. I'm not giving any investment advice, obviously, to anybody here. But NVIDIA has had numerous drops of like 30%. By the way, it had a 30% drop last year, like around, I think it was like July or August timeframe, whatever it was. It was a 30% drop. I don't know how many people really had the guts to hold it at that point of time.
Yeah, right.
Especially, think about it, if you put yourself in the shoes of a software/internet investor who sort of bought a couple of semiconductor names, one of them NVIDIA, just because he didn't want to drag behind the NASDAQ index.
Yeah.
How much understanding and knowledge you have at this point of time, and how much holding power you have when it's down 30? You know how easy it is to buy the narrative that says, oh, scaling laws are over. Oh, that's the peak. It's very easy to buy this narrative.
Yeah, and you get some allocators coming at you saying, money quarterback. Why didn't you sell, Val?
Yeah, why don't you sell? I mean, seriously. So then the same power comes into play also. Ultimately.
But I remember, I'm not sure it's exactly the case, but you'd beaten the S&P and the NASDAQ and you wrote about this with half the exposure. And that's worth a victory lap right there, because we've been in a bull market. But, we may not be forever, right? And so, could you talk a little bit about being long and short and why shorting is important to what you do?
Yeah, totally. Absolutely. So shorting is actually it is very important because it absorbs a lot of the negative volatility. I mean, it's great to be in a bull market, which basically gives you a positive volatility. But these bull markets are not straight up. Even in the bull market, there's tons of pullbacks constantly. And shorting does help from that perspective. And actually, many of our shorts have been very heavily alpha generating shorts. I mean, some of them have been absolute dollar P&L generating. Many of them have been alpha generating because, let's be honest, for every NVIDIA out there, which there are not that many of them, you have a ton of companies exposed to mature, no-growth areas like smartphones, PCs, LCD panels, all kinds of consumer electronics that doesn't grow that much at all. So there's not a ton of, so there's a chunk of our universe which is still kind of mature and cyclical and a trading vehicle at the end of the day, which lends itself to, by the way, being shorted or trading from a shorting perspective. And when I was talking about negative volatility, you mentioned bull markets, it's true, but think about the amount of volatility that has happened since we launched the fund. Like we launched the fund in August of 2018, and then President Trump, in his first presidency, started a trade war with China literally the next 2 weeks or so, which triggered an inventory downside. Then there were export restrictions on Huawei. Then there were export restrictions on a whole list of other Chinese companies. Then there were more export restrictions on semiconductor capital equipment, on all kinds of stuff that can be sold to China. Then we had COVID, which shut down the world like a pandemic that we haven't seen in 400 years. Then we had an inflation that we haven't seen in 50 years. Oh, by the way, we had a small recession in between. So this hasn't been a smooth ride at the end of the day.
No, right. But it is. And even what you said about over-ordering, under-ordering, I know from my perspective, just watching Intel and what's happened there, it's been extraordinary. And the American icon, it's, really now might be broken up. It's amazing.
It probably needs to be broken up for it to survive. Sometimes you sort of have to break it to make it, ultimately. So there's been a lot. So from that perspective, having shorts has been quite important, ultimately. Right. And that actually was quite an interesting realization for us and sort of led us to the path of operating a market neutral strategy, which we opened about a little over 2 years ago, which in of itself has done extremely well also because of the alpha generation.
Right, especially cyclical sectors. The way you're describing it really does lend itself to that.
The cyclical things, I mean, by the way, smartphones, for example, right? Do you know when was the peak of iPhone sales? It was 2015. Yeah, in 2015, Apple sold, I think it was like 240 million units. And since 2015, the yearly sales have varied from 200 to 240. That's it.
Oh, wow. Well, they made up for it elsewhere, I guess. But,
they made up in services, yes. They've done better in other things, yes.
So maybe one of the things I really would love to touch on is China. And I know everybody's focused. I mean, we're lucky to live in the United States where all of this is emanating from, whether it's AI and just semi-development overall. But China has done very well. And, maybe you could just give a quick assessment on how big a competitor they could be to a lot of the Western technologies and how much they're getting to cutting edge semis, if they are at all. And we'll see. There's a lot going on. There's a lot of politics, but just give us the state of play today as you see it.
Sure. Look, China should never be underestimated. That would be a humongous mistake to underestimate China. Just believe that the US is like decades ahead. And to be honest, let's face it, how many Chinese companies have you heard that buy software from the American companies? I mean, how much revenue do you think Microsoft or CRM or ServiceNow have from China? I would venture to guess it's very, very close to zero. You know why? Because they do it all internally. They have plenty of software engineers that can replicate, copy paste, and do that. Because ultimately, the barriers to entry in software and internet are extremely low. They're non-existent. So they have copied all the internet models, right? They have the Babas for every Amazon. They have the Baidus for every Google. And for every software company, they have internal software. So this whole thing of internet and software has completely been taken by the Chinese. The only place where they haven't been able to not take it, but to catch up, I should say, is semiconductors in general. And I would say that even there are many shades of gray. It's not black and white. So it would be wrong for people to believe that China is behind the United States by a decade or two in every single type of semiconductor. That's not true. I'll tell you, for example, that in terms of NAND memory, flash memory, where we store our videos and whatnot, they're not way too far away. They're like 2 years behind. In DRAM, which is the operating system where you put the operating system, they're probably 3 years behind. So they're not that far behind. They're like 2 to 3 years behind, right? Then if you start talking about analog semiconductors, if you're talking about high performance, they're definitely further behind. They're probably 5 years, 7, 8 years behind. If you start talking about semiconductor capital equipment, then it depends, right? For some stuff like cleaning equipment, which is not very complicated, they could be close to on par. But if you're talking about lithography like EUV, I mean, they're like 5 decades behind. They have zero chance of EUV of like any day soon.
What could you explore why is that? I mean, is it that bleeding edge that you just can't copy what other people are doing? They clearly have these machines and they can probably deconstruct them, but why is it that is so far behind?
Oh, so the EUV machines they don't have because sanctions have forbidding ASML from shipping any EUV machines into China. Can they go to TSMC in Taiwan and look at them? Sure, I'm sure they've done it. Of course, and there are many Taiwan semi engineers who move from TSMC into Chinese factories, so they've seen that. I think it's coming down to it's a good question. It took the Dutch over 15 years to be able to develop that technology. And that was a joint development with Samsung and Intel and everybody else. They actually poured up a bunch of money for ASML to be able to develop it. The level of precision that you need there, if I remember correctly, you cannot afford imprecision, which is more than the size of a human hair compared to the surface of the moon. So that's what we're talking about. So Carl Zeiss in Germany had to create these lenses which are that smooth. And then you have to blow up tin like plasma temperatures. It's very hard to replicate this stuff. That's sort of the feel we have at this point of time.
Right. It's very interesting. Well, maybe the last thing we could go through, if you don't mind, is we could riff on the future a little bit. I would love to hear what you think, how things will play out, and how us as investors or even just humans, how all this stuff is going to come together in our lives in the next few years. And it's a tough one. That's a big one. Sorry.
Yeah. Okay. I mean, look. So let's focus that question probably on more like AI, because ultimately this is sort of the transformational technology. I mean, look, as far as I'm concerned, AI is the most transformational technology that I have seen in my lifetime. That's simple as that. So let's focus on that for the next few years, how that's going to develop. I think that the pace of development will accelerate. And by the way, the pace of development is already super fast. I've never seen anything develop so fast. I've never been that busy in my lifetime before. I've never been forced constantly to read, even on every weekend, constantly what's going on, because something is happening all the time. So you have to know what's going on there. But okay, so I think the pace accelerates. Let's riff a little bit about, that's my best guess here is the following, in terms of like far-reaching outcomes. We probably do reach AGI, whatever AGI means. I don't even know how to define it, but something very close to human intelligence, something that really does replace a lot of the boring work that we do all the time, really completely obliterates a bunch of boring work. That may very well happen faster than what people think. People will be thinking 5 to 10 years. It may be 2 to 4 years, for all I know, to that moment. Darkness itself will have transformational effects on human functionality, like what do we do as humans and who does what. Hard for me to imagine exactly how that develops, because we have seen the Industrial Revolution change and people were worrying about, certain sets of people will lose their jobs, period. But there will be new jobs that open up, And it's very hard for me to imagine right now exactly what these new jobs are. Like I can tell you right now, I don't think 2 years from now, probably even a year from now, there will be call center reps. I mean, there's no point to have call center humans when this stuff can really be sitting there, be doing a much better job than a call center guy. But how many parents do you know that say, I want my child to be a call center rep when he grows up? I mean, this is a job that's really kind of inhumanly boring. So it should be changed. It should be replaced. I can imagine also, I can totally envision there will be a ton of development. There will be like new materials, but like material science will explode completely. There'll be all kinds of new stuff. Genomics will explode. Medical research will explode, will vastly accelerate, which by the way, I'm excited about because, 15 years from now, I would rather have a cure for the diseases that my parents had as opposed to not. So there's a lot of excitement as far as I'm concerned for that stuff. Now, in terms of the more of the tech landscape, I can totally see humongous changes in the tech landscape also. If I'm thinking about, so I'm going to move a little bit away from my space since we're just riffing here. I wouldn't be surprised if a lot of the SaaS software names are kind of gone at some level. I mean, it's not ridiculously hard to imagine these new agents which are getting built as we speak, and these agents will be built on the reasoning models I was talking about. These agents can probably very well replace the CRMs of the world or many of these other systems out there, because ultimately these software as a service models exist because there was this huge shortage of software developers in the country. And if you had plenty of software development talent, you would have done it in-house the way the Chinese did it. I mean, the Chinese don't use CRM. They do it in-house because they have their own software developers. So I can see whole ecosystems where a lot of hedge funds made their bread and butter and their wealth could very well vaporize over the next 4 or 5 years. That's kind of the way I'm thinking about it.
Yeah, it's very interesting. And, and not on a negative note, but like, Skynet or the Matrix. I mean, you can understand the negatives to AGI a little bit in military and different things, or positive. I don't know. I mean, it's not something that's actually pertinent to you today, but I'm just wondering if you had any thoughts on that.
Well, I mean, look, the ultimate thought, I guess, we're going is, could we have a Terminator moment, right? Where we get completely smoked out by AGI. It's possible, right? I don't think it's impossible. It's hard for me to put a probability on it. Since we're totally riffing here, I wouldn't be surprised if there's a 5% chance of that happening. I don't think it's 50 or 15, but I don't think it's 0 or 0.5.
Well, what about, one of the things you've done a great job on kind of elucidating is just active management. Because I get the question a lot lately about, how would you invest in AI, right? And, I don't even know what to say. All this stuff NVIDIA obviously is run and Meta's run. But these guys, a lot of people are looking for it on the retail side. I would say on the institutional side too. And the problem is, right, Val, we don't know what's going to happen in the next 6 months, and we don't know how it will develop exactly. And it's not a linear path. So you make a good case, I think, for active management. I mean, any thought on that? Because there isn't like a great AI ETF. I mean, they exist, but they're not very good.
Yeah, I mean, I think they're very small. These AI ETFs, they're probably small liquidity also. I'm not even sure how good they are. I mean, often enough, people would say, well, maybe just invest into the semiconductor index, like whatever SMH or SOX or whatever it is. But first of all, you have all kinds of other constituents there, like Intel, for example, which hasn't done that great over time. He's done extremely poorly as a constituent for these things, which drags performance. And then also you have periods like where these ETFs don't do anything for a while. I mean, for example, if you look at the SOX index or SMH, or whatever it is, from April of last year until December of last year, it didn't do anything. It was kind of flat for like 9 months. We actually succeeded to make a ton of money for that period for active management, for just pure alpha generation from both longs and shorts. So I think there's still, I believe there's a ton of opportunity in active management. There's a ton of opportunity in identifying who is really going to win over time. Things can change, by the way, right? Things can change very quickly. Like you said, Intel used to be the thing in semiconductors for a long, long period of time. And right now it's kind of needs to be broken up to survive. at this level. NVIDIA has done very well. Who knows? 3 years from now, 2 years from now, I think, by the way, it has staying power, but who knows? Like 3 years from now, maybe not. And being actively involved and seeing that inflection that may happen at some point in time, that's actually instrumental.
Well, Val, let's leave it there. That's great. I think I always learn something from you. So I really appreciate you getting on here, and I bet people really enjoy learning from you. So thank you very much.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.